Hey there, everyone. I'm Ryan Schul. Welcome to my channel. So, in the project today, I want to talk about portfolio risk management. We're going to use Python for all the examples here, as usual. Like, I think at this point, 99% of the of the tutorials that I put together are all Python based. I think Python is very scalable up and out. It can handle all kinds of demands. It does all kinds of machine learning, data science, artificial intelligence, deep learning, right? So I think it's a good tool for many different users' needs and many different applications. So what is portfolio risk management? It's basically for protecting capital, ensuring long-term returns, and meeting investment goals. Okay, when we get into the market, we don't just want to throw money around. We don't want to throw darts at the dartboard like a monkey. You've probably seen this picture. The monkey throws a dart, hits the dartboard, and that's how he picks his stock. And in some cases, the monkey can do just as good as, and maybe even better than the professional, right? But we don't want to be that monkey. At least we want to put in an effort and do our due diligence, right? And try to, have a peace of mind after we have done all the analysis and the research. So this can help us limit losses, preserve capital for the firm that we work for or for the clients that we work for, achieve risk-adjusted returns, basically stay within risk tolerance for compliance purposes or for the mandate of the firm that we work for, comply with regulations and mandates, understand and quantify tail risks. Okay, we'll look at that a little bit later. Improve asset allocation. We'll see an example of that. Enable dynamic decision making, support long-term capital, and basically boost credibility with our stakeholders. And this just shows professional discipline too. Okay, so let's go ahead and grab some data here. We're going to go to the Yahoo Finance endpoint. So the library is right here. These are the tickers I'm looking at. These are all the components of the Dow. So I'm actually going to do a little sector analysis. It's actually pretty hard to get sector data from Yahoo Finance. I know what these companies are, so I just created a dictionary with key value pairs. The key is on the left right here, separated by the colon, and then the value is right here on the right. So these are all key value pairs embedded in a dictionary. And by the way, you can get this data. I mean, I looked at it. It's kind of hard to get. I can show you what I was looking at yesterday. I tried a few different things to try to screen scrape it, but I guess the HTML element that was behind the item that I was looking for was just maybe mislabeled or dynamically generated using JavaScript or something like that. I just couldn't get it working. And I don't want to put in tons and tons of time. I know what these companies are, so I just created my own sector profiles here. But basically, you can get sector from here. Okay, so you would go to the ticker symbol that you want in profile. This is Microsoft MSFT. Okay, and same thing over here, sectors technology, and industry is software and infrastructure, and they actually have the full-time employees as well, so pretty useful stuff. And it just disappeared on me. So what the heck was that? Let me go back here. It's a little bit buggy, right? Sector and well, sectors. What is going on here? I think we have a different URL. Yeah, let me go back here. Okay, something went off the rails. We would just go to profile, and we should be able to find the information over here. Okay, so this is sector, and this is the industry, right? So I think I clicked on this full-time employees or something. Whatever, that was a mistake. So that's how we can artificially create our own sector mapping right here. I tried screen scraping it again, but it just didn't work for whatever reason, and I don't want to spend hours and hours trying to do that when I can do the same thing in a couple of minutes. So, okay, so we have the data imported here. This looks good. I just noticed I have the libraries twice. I don't need that twice. So I'm going to assign sector preferences and weights as multipliers. Okay, so technology, I'm assigning 3, healthcare 2, consumer discretionary 2, and these are somewhat arbitrary, but I think they're pretty realistic. Okay, that's why I picked these numbers. It's not coming from any website or anything like that. I created this, but based on my knowledge of capital markets here, I think this makes a lot of sense here. Okay, in terms of like the riskiness and the volatility of these types of investment vehicles, right? Or just stocks. This really isn't a vehicle. So again, we see the key value pair. Here's the key, here's the value, and we have a dictionary evidenced by the curly braces right here, okay? So I go ahead and for ticker and tickers, I create a small loop here, sector, map the sector. Otherwise, if it doesn't match, pick other. I have the sector preferences and I get the sector, and then I assign weights. I assign weights to all of these portfolios based on sector preferences, right? So technology gets a higher weight, materials gets a lower weight. So I'm just saying basically like higher weights are a little bit more volatile, materials are a little bit less volatile. So Apple is going to have a higher weighting in the portfolio, right? We want this to be tech heavy, whereas Microsoft MSFT is right. Amazon 0.04. So what was Amazon? Let me see. That's AMZN. Oh yeah, consumer discretionary. I was thinking tech. It's really not. But where's Microsoft down here? MSFT. Yeah, 0.61244. Okay, so that's technology like Apple. So we're just assigning weights based on the volatility of the overall portfolio. Okay, and the sum of the weights equals 1. So that makes sense. So we can go ahead and set a dynamic time reference here. So we're looking at time series data. This is temporal. We're going to go back in time 12 months, and the end date will be today. We go back in time 12 months to get the start date. That's how that works. And we will pull in the adjusted close data. It used to be, I'm sorry, we're pulling the close data. It used to be called adjusted close. We're pulling in the close data. And this is resampling to the last day of the month. And we're going to have 12 months of data. Okay, so this runs, we get the data right here. So we're going to do a couple things. We're going to calculate the annual volatility of the portfolio, the 1 day value at risk, and then 1 day CVaR, right? So CVaR is sort of like the value at risk less than the value at risk and the average of that. Okay, that is evidence right here. So here's the CVaR at 95%. So we set a confidence interval. This comes from over here. Okay, portfolio returns. VaR is portfolio return, and 5 is giving us within 5 degrees of confidence, 95 degree of confidence, right? This gives us the VaR 95, and we're using less than the average of the VaR 95 to get the CVaR 95. Okay, so again, we see the annual volatility of the whole portfolio, 17%. We can expect a 17% differential in portfolio returns. The 1 day value at risk, so the portfolio with 95 degree confidence can't lose 1.6%, can't lose more than 1.6%. Now it could, but we're 95% confident that it won't. And the 1 day CVaR, which is less than the VaR, it's always less than the VaR. You take all the values less than the VaR, but not the maximum of that, the average of that, right? So we have the mean over here. Okay, so hopefully that makes sense. And we use VaR for compliance reporting. Again, the value at risk, how much of this portfolio is at risk. If we have a $1 million portfolio, 1.6% would be about $16,000, and 2.51% would be about $21,000 or $25,100. That's the CVaR, right? So we're 95% confident we can't lose more than that. And again, it could happen, but we're pretty certain that it's not going to happen, okay? So CVaR is basically for understanding worst case scenarios. And this is also for a pretty bad trading day, but CVaR could be even worse, right? So moving on now, we are going to calculate the risk-free rate. We are going to look at portfolio returns and get the daily Sharpe. So the Sharpe ratio is the item that we're looking at minus the risk-free rate, or the return that we're looking at minus the risk-free rate divided by the standard deviation, because we want to normalize this portfolio's deviation of price over time. So how much does the portfolio value change over time? If it's a small change and pretty large growth, you can imagine the return minus the risk-free rate, which is probably going to be about 3% in this case. It might be a little bit high actually in this current environment, but we can go with 3%. We're getting the daily rate, so we divide by 252, right? Because it's 252 trading days in a year. These are days that the market is open. Obviously, the annual calendar has 365, but remember, we have every Saturday, Sunday off. The market's closed, and we have about 11 holidays, including things like I think Labor Day, I think Memorial Day, Christmas, Thanksgiving, 4th of July. What else? New Year's Day, right? And there's a handful of others. So we have 252 trading days. We get the risk-free rate. So again, the higher the return and the lower the standard deviation, the higher the Sharpe ratio, right? Higher is better. 0.04 honestly is a little bit low, but the risk is pretty low too. So we can tell that the portfolio is pretty well diversified, and we have a very low risk exposure here. So I think we're in a good position. Although you could make the argument, if this investor profile or this investor group has a high appetite for risk, then we're going to have to pick some more risky securities over here, right? So this is all the Dow 30 components. These are not super risky. These are blue chips. They're pretty reliable. You're not going to make a ton probably. Maybe long term, if you hold these for years and years, you could make substantial returns. But in the short term, it's not that volatile. It's not that risky, right? So pretty steady Eddie, whatever it's called. So that's fine, right? So pretty low Sharpe, but pretty low risk. The daily Sharpe is here, the monthly is here, and then the annual Sharpe ratio is here. So again, higher is better. If we held this portfolio for 1 year, we can expect a Sharpe of 0.5. Really, we would like to see something like 1, 2 would be great. 3 would be phenomenal. Let me see. What would be the average Sharpe ratio? Good Sharpe ratio. In this market. I don't even know if I need that, but let's see what Mr. Google has to say. Not interested. Good Sharpe ratio is considered to be 1 or over. Okay, so we're a little bit more than halfway there. Again, these stocks are pretty timid. I mean, it's not going to move a lot. There's not a lot of volatility. So if you really want to get closer to 1.0, that's totally fine. You'd have to pick different stocks, measure the stock's volatility, measure the stock's beta with some type of benchmark. It could be the S&P 500. That's fine. We could do an exercise in that. Maybe I'll actually put together a video on that because I did touch on that on another video that I recorded earlier today. I'll push it out soon. I'll drop this one right after I put that one out. But I just want to show you the calculations here. Again, risk-free rate. The excess return is a portfolio return minus the risk-free rate. And the daily Sharpe is the excess return divided by the standard deviation. Okay, so you can create, you can do it two ways: portfolio return minus risk-free rate divided by excess return, or just do the subtraction first, then do the division. The daily Sharpe is right here. Daily Sharpe times 21 trading days in the month gives us the monthly Sharpe, and daily Sharpe times 252 trading days in a year gives us the annual Sharpe. So that's how we get that. So if we sum all the weights, the sum of the portfolio should be 1.0, okay, because this is a weekly, not weekly, this is an evenly balanced portfolio. If we allocate more stocks to Apple and more stocks to, or more weight to Apple and more weight to Microsoft, that's certainly doable. Okay, we did add a little more weights over here. But I mean, if you want to buy more shares, right? So this is adding just like a risk weight, sort of like a risk weight index. If you want to add more shares, we can subtract some shares from some of the other stocks and reallocate those to Microsoft and Apple, if that is the request of the investor here, or the client that we're working with. That's not what I'm doing. I'm just making equal weights here, just assign higher risk profiles to the tech stocks. So the portfolio mean return is about 0.005. So again, pretty low, but pretty low risk too. And the portfolio standard deviation is 0.019, right? So very conservative portfolio. This is for a long-term investor that wants to sleep well at night, not necessarily eat well in 10 years, right? There's always a trade-off between risk and return. You can sleep well at night knowing that you're pretty safe. Your investments aren't going to blow up and fall off the face of the earth tomorrow when you turn on the stock market and it's 9:30 o'clock. But at the same time, you're not going to eat well because you're not going to make tons and tons of capital gains here. Okay, so you have to pick which one you want. Let's take a look at Herfindahl-Hirschman Index. So this is the sum of the weights, and we are using HHI over here and taking this to 4 decimal places. The weights are going to be 30, so pretty evenly balanced. Although we are going to take the top 2 stocks, which are Apple and Microsoft, and allocate 80% to these and then assign the rest of the weights to the rest of the stocks here. So 0 to 2 is the first record to uh, to the beginning of the second record. So if you look closely here, um, where was it? Apple and Microsoft? I thought I saw that. Where was it? Oh, wait, I lost my train of thoughts. Where are we? Weights. Let me just print this real quick here. Weights is going to be what? Oh yeah, see, so it's evenly balanced. But where would be the NP weights? That's fine. Okay, so we're going to take just these weights, assign 80% to the first two, and then assign the rest two to the end. This is the slicing, right? So you begin in the first column. If you have something in the middle, that would be the step number. So you could step 1, 2, 3, 4, 5. Like you could skip items, and then the last would be where you finish up. If you don't put anything in the last place, it goes to the end. So we start at position 0, 1, we finish before 2, and then we go 2 to the end. Okay, so if I print out the results here, the HHI measures concentration of risk at a glance. Regulators and institutions use it to flag over concentration in a portfolio, and it helps us to quantify the impact of overweighting positions. Okay, so there's a few different ways to do this. You can look at the beta of the securities in the portfolio. You can look at the HHI. You can just manually assign heavier weights or to certain stocks that you favor and lower weights to other stocks that you're not too fond of, right? Or you can just buy more shares of Apple and Microsoft if that is your preference, right? So there's a few different ways to skin the cat here. So you have to decide what your objective is and then go with that. So we can do an effective number of positions, which is 1 divided by HHI. So you just take the inverse of that. And basically, this effective positions 1 divided by HHI takes the inverse rate. 1 divided by, what is this? 1.28 is 0.78. Okay. And basically, this provides intuitive interpretations of the diversification of the portfolio. It helps us compare nominal versus effective diversification, and then how everything is spread across all the holdings. Okay. And this ENP, effective number position, just gives us better diversification and helps us understand higher concentration risk. Okay, so you have to understand what's in your portfolio and the concentration of that risk in your portfolio and manage that. If you can't do that, then whatever happens to that portfolio is really random, right? You have to understand the metrics or the quantitative aspects of these assets that you're managing, right? Or you could be in for a very rude awakening. So here's an 80% assigned to the first two. Okay, so again, that came from over here. So the first two records get 80%, and we take 2%, divide by the other 29, and assign that to 2 to the end. Okay, so there's the rest of the stocks. So even weighting between the rest of the stocks, Apple and Microsoft get 0.80. And again, the sum has to add up to 100. So we're just saying give 80% and 80% to the first two, and then evenly weight the rest of these. But the sum is still going to be 1%. Okay, so we're just giving more weight. The tool here is going to figure out how to redistribute those numbers of shares. Okay, so we can look at the top end exposures. We're importing NumPy. Okay, we do this a lot, looking at the top 5 or the top 10 or whatever you choose over here. This is a comment, right? So we're not actually doing this. We're only getting to the top 5. And we look at the sorted weights and the top end exposure. So the top 5 exposures, okay? So we're looking for the weighted series, sorting in descending order. So ascending equals false is the same as descending. I don't even think we have descending per se. I think it's only ascending equals true or ascending equals false. And the top 5 exposure will give us 162% of the sorted weights. This is not the return on the portfolio. This is the sorted weights of the portfolio. And you can see the top holdings now is Apple, IBM, V, Microsoft, and Cisco. Okay, and the top 5 exposure is 30.61%. So again, these aren't returns of the portfolio. These are the exposures of the portfolio. So this kind of risk management is a little different from some of the other videos I did. In other videos, I focus on portfolio optimization, different types of risk management. I did one on anti-money laundering, one on probability of default, loss given default, exposure at default, one on, what was that? Fraud detection, right? If you work at a bank or some type of money institution, people are always trying to break in using some cybersecurity threat and steal your money, right? So fraud detection is a big one. I have a video about that. But the the focus here is a little bit different, right? We're not looking at returns per se. We're looking at exposures. We're looking at HHI. We're looking at weightings of the portfolio. Okay, here's HHI. We're looking at the weights of the portfolio, Sharpe ratios, and VaRs and CVaRs, right? So some different types of metrics. There's all different types of ways to do portfolio risk management. This is just a different angle. I haven't done this one yet, so that's why I'm introducing this approach today. And I think it's too much to make a video that just covers everything to be comprehensive, and that would just drag on and on. So if the topics get pretty big and pretty comprehensive, I try to break it up into bite-sized chunks so it's easier to digest, right? So this again is different angle of risk management from a different perspective, but trying to hit some of the big items here. Okay, so again, concentration risk. So we define that. We try to manage that and redistribute stocks in the portfolio, especially the two tech stocks. We looked at Microsoft and Apple, so I think we accomplished that mission. We looked at the HHI, the VaR, CVaR, Sharpe ratio. So we checked all the boxes there. Price risk. Basically, this is a risk that the price of an asset changes unfavorably regardless of diversification of the portfolio, right? So if you have a portfolio of bonds and interest rates go up, bond prices will go down. If interest rates go down, bond prices will go up. Okay, but we want to understand, that's a little different, I guess. I'm going off a tangent, sorry. We want to understand price risk, right? So if prices of the portfolio change, typically if they depreciate, then you're losing money. If you have a lot of short positions, then you want the portfolio to actually, you want the prices to depreciate, because then your portfolio will appreciate, right? Because you have the opposite end of that, position. That's kind of a different thing, but that's something to definitely be aware of. And remember, all stocks could fall due to a macro shock. Okay, I have a video on macro shocks, and I'm going to throw that up on YouTube later today. And again, just to close out here, we always try to focus on volatility and downside risk, as well as diversification. I should put as well as diversification. Okay, so these are all important items to be aware of. Okay, so that pretty much does it. I'm going to save my change here. I am going to export this to an HTML file, and I will share all my code here when I share this video today. I'll try to drop it later this afternoon. I have to run a couple errands right now, but I'll try to drop that down in the next hour or so. Thanks for sticking with me to the end. Hopefully this was informative and enlightening. I tried to do all the videos to be engaging, to be informative, to be useful, to be practical, and to show you a bunch of different techniques of how to do data science, how to do machine learning, deep learning, AI. A lot of these are focused on finance. This is obviously like a financial topic here. I've got a few on risk management at this point, and I'll probably put together a few more. I think I'm up to video like 309 or 310. So my goal is to do 365 in 365 days. My deadline is August 8th, 2025. So it's less than 2 months away, and I think I have another 50 videos to put out. So I think right on target, right where I need to be. So looking forward to that. 365 videos in 365 days. Yeah, guys, I'm going to wrap it up here. Thank you so much for your time, and I'll see you in the next video. Goodbye for now.